When you stare at a trading chart plastered with a dozen custom indicators, the information often dissolves into a swirling mass of unpredictable chaos. But the open market is actually an auction. Every tick up or down is the real-time result of buyers willing to pay higher prices or sellers aggressively offloading inventory. Your objective is to identify whether the buyers or the sellers hold the leverage, and then position yourself alongside the institutional money driving that direction. This requires a strategy centered entirely around two metrics: market structure and momentum. Focusing on these raw, unfiltered data points provides a specific, repeatable set of rules for reading the market, which helps eliminate the need to guess. The process begins with the broad terrain. Zooming out to a 15-minute chart allows us to look at 2 to 3 days of total price movement to identify the overarching trend. When an uptrend forms a new high, pulls back, and breaks past that peak, it creates a break of structure, continuing the trend. We then look for a violation called a change of character. If price drops past the previous low, sellers take over. Spotting this specific structural shift allows you to anticipate a completely new downward trend before the majority of the market recognizes the reversal. Tracking these breaks clarifies the chart. What initially appeared to be random price spikes resolves into a definitive map of who owns the market at any given hour. Once you know the direction the market is heading, you need to identify the exact coordinates for an entry. That requires reading momentum. This diagram illustrates a fair value gap. It happens over a sequence of 3 candles, when the wick of the first candle doesn't overlap with the wick of the third, which leaves empty space between them. This gap represents an area where bidding was so aggressive and so heavily weighted to one side that it pushed the market right through that price range, creating a temporary pricing vacuum. Because the market didn't have time to determine the fair value of that zone, price naturally rubber bands back to retest it, seeking equilibrium before continuing. These highlighted blocks are precise markers where massive institutional volume pushed the market. With our target zones marked on the 15-minute map, we move down to a 1-minute chart to execute the actual trade. We wait for a specific 3-step trigger. First, we look for a sudden change of character on this 1-minute time frame that aligns with our overarching macro trend. Second, that specific structural break must generate a fresh fair value gap in its wake, confirming heavy momentum is driving the reversal. This graphic shows the final step. We wait for price to pull back exactly to the 50% midpoint of that new gap before we strike. Immediately upon entry, we place a stop loss directly underneath the recent structural low to cap the risk. Moving from a broad structural view down to a strict momentum-based entry distills millions of scattered data points into one high-probability trigger. Professional trading operates as an asymmetric math game. Success does not require a flawless win rate. This chart illustrates the risk-to-reward ratio. By capping your potential loss at a single unit of capital, while setting your take-profit target to capture 4 times that amount, a single calculated win easily absorbs the cost of several losing trades. Even with a small personal account, tools like leverage or prop firms allow you to use a strict $50 risk model to control massive positions in the market. Repeating this exact sequence day after day treats trading as a scalable business process. When you strip away the flashy indicators and execute the raw mechanics of structure and momentum, you dictate the terms of your own trades.